Bom dia, Lisboa. Good day, everyone. It's great to see such a full house. We have a very, very important topic to discuss, scale versus profitability. Let me ask an opening question to all of my three members on this panel today. In 60 Swiss seconds, which are actually 59 seconds, to be honest, what is more important, scale or profitability? If I can start with you, Fred.
I think the debate is poorly framed because scale versus growth, profit versus growth are choices, they're pathways. And if you're a founder, what you really care about is sustainability. And sustainability, at the end of the day, is all about free cash flow and unit economics. And there are different paths that you can take to get to the same outcome. So I think it's more of an ideological debate than a good substantive framework to think about the problem.
Sarah, in the past, we always wanted to scale first, right? But in this current environment, which is so tough, people seem to want to make money fast, really fast profitability. What's more important in your opinion?
I'll take a simpler stance than Fred. Scale remains the lifeblood of startups. Without rapid compounding growth, you're irrelevant on the global stage. And so the changing economic environment of the last year or so has really made startups rethink, return on investment versus money being free, but scale is still primary.
I would totally agree with that. And the fact is that venture capital is not the path for all startups. For the ones that really want to build big outcomes, I think scale is paramount. And I think there is a little bit of a, we're fooling ourselves going on in the industry when we think we can both create massive scale and grow profitably at the same time. That's just not possible with many, many business models.
We see a huge shift in this dichotomy as well, isn't it? Sarah, if I could start with the first real question now to you. You just left Greylock to start your own business, Conviction Capital. You raised $101 million, so congratulations on that in this very difficult, challenging market environment. You focused on AI companies, right? So how difficult is it for you in this circumstance, in this world that we live in today to raise funding?
I'd start with, I've never raised a fund before, so I have nothing to compare it to. But I have renewed empathy for entrepreneurs because fundraising is never that much fun, right? You want to get to the business of building your business. But the thesis of the fund is pretty simple. It is that we are going to build more intelligent software over the next decade, more data-driven software, and that we're on the right side of the curve for many different advances that are happening right now in the power of machine learning models. We just heard from DeepMind, in the greater availability of data and the cost of compute going down. And I think that story is one that is going to have horizontal applicability across a lot of problem domains and is one that resonated with LPs and with founders. And then the macro environment is challenging, and I'm biased here, but as a significant LP in my own fund, I'd say I think it's a really good environment to be an early stage investor. I think it's going to be a good vintage.
Fred, would you agree with that? Because we have, for example, the IMF, the global lender, predicting that global growth has slowed down in 2021 to 6% this year, about 3.2%, and then next year further slow down to about 2.7%. What's the fundraising environment and your outlook like for the next couple of months?
So PJ and I, we're one of the few left that were here in '99. And this crisis is particularly complicated and sticky because it's like energy, climate, supply chain, and I don't think we've seen the impact yet. If people have their energy bill go from 200 euros to 800 euros a month, or their mortgage rate triple, I don't know that we fully internalized that. So I think the market's going to be awful. The good news for founders is that
don't soften the blow, Fred.
Well, it's better to be prepared, right? But as founders, we are highly adaptable organisms. We thrive on chaos. Actually, we can leverage what Sarah is investing in with super detailed analytics, real-time intelligence. And so we have these quite unique tools to thrive on chaos. So I think it's going to be slower, more painful. Prepare yourself to run a marathon, and you don't know how long it's going to be. But startups are uniquely positioned to thrive and survive. And there is a wall of cash on our side that's waiting to be deployed. You know, PJ here got $1 billion fresh money, so you know,
absolutely, PJ. You did raise quite a lot of money most recently. I believe that you made about $1 billion US. Got that for a new fund. It's your largest fund to date, about twice the size of your previous one with Northzone. But would you agree with Fred here that this is a different kind of beast, this COVID-19 pandemic, and are we going to see a bloodbath?
So first, I think it's important to set in context and compared to the prior crises also that we have like a digital shift that is still going on, where we're sort of basically decommissioning a big part of the industry and also how the societies run and how we live. And at the same time, we have a sustainability shift where we are decommissioning old dirty stuff in favor of cheaper and better stuff for the environment. And that shift is sort of happening within this context, which means that there's a lot of capital available for those who can prove traction and to address these mega trends, so to speak. You know, I don't think that we have seen any shortage of entrepreneurial activity, even in these, you know, troubled times. And also, it's a very strong time to start recruiting from a pool of talent that may have been laid off from Google or from Facebook or any of the big platform companies that are now focusing on profitability. And you get people who knows what great looks like, and they want to go at it again. And there is, as Fred said, a wall of capital and new tools to be deployed. And so pretty much every company we look at, they are, you know, they are killing it left, right, and center compared to the incumbents.
We have 3 VCs here on this panel. PJ and Fred, you're both from Europe, and Sarah is based in the US. Do you think that a lot of VCs will actually survive this crisis, Sarah? Will there be more activity, as PJ says, or will the big fish eat the small?
So I have a basic framework for this, which is in times of abundance, you have more experimentation. And in times of scarcity, you have more consolidation, right? And this is now a time of relative scarcity when you look at LPs. Congratulations on your fund, but LPs, the people who back venture capitalists, are in a bad place right now, right? They've seen their portfolios take a really serious hit. They're looking at what's happening in the global markets. They're less risk on than they were a few years ago. And what I think that means is a lot of the experimentation that has not worked out over, or is more questionable over the last few years. So let's say venture managers, fund managers who understand less about investing, or venture managers who expanded into a growth fund and then ended up with mediocre returns, or who came in from different asset classes, I think that they will struggle. Because any student of economics understands it is very hard, it should be very hard to generate massive returns. I think on the other hand, venture as an industry is indexed to technology, right? And I'm again biased here, but technology is the engine of productivity and growth for the world. And so if that is becoming a bigger part of our lives, venture as an asset class should also become bigger. So I think you'll see both dynamics happen.
In our pre-chat, Fred, when we spoke last week, you mentioned that the real successful startups are going to be those who can craft a story, who are real storytellers, who have something to sell in terms of story. You mentioned, for example, Be Real, the French startup, the photo sharing app, which raised some 60 million euros in funding earlier this year. What will be the secret for them?
So if we take the Be Real examples, interesting, or we can take YouTube if we want to a better known example. So if you're building YouTube or Be Real, you have to grow. So YouTube, for example, cannot monetize if it doesn't have hundreds of millions of users. Similarly, it has to build a video delivery infrastructure that makes their costs fixed instead of paying for bandwidth. So that's an example of a company where a profit-first approach is completely useless. It will not lead to sustainability. So that's a good example of growth is the way by which you achieve sustainability. And my point on the narratives was if you can go to capital markets and you can explain that story credibly, it is our business to fund founders through these gaps. And whether you're building YouTube or you're building a SaaS company, these are 5 to 7 year projects that take anywhere between $50 and $200 million in capital. And as PJ said, it is difficult to escape gravity when you're building growth companies. So I think the quality of the story you're able to tell financial markets is becoming even more important. And all of our startups need these beautiful narratives that people can get behind.
PJ, you joined Northzone in 2004, so you have quite a lot of experience already. It seems like, scaling versus profitability, this whole measurement has changed a little bit, this dichotomy. It really depends on a case-by-case scenario. Or when can you say nowadays, this is a trade-off, this is where we go from scaling to profitability?
Yeah, so I think the key for any entrepreneur is to make sure that they are masters of their own destinies. And if you are too reliant on capital markets that become shaky like they are today, you need to make decisions that you don't want to make in order to achieve those goals that you have. And 2 years ago or a year ago, you could basically cook up a really exciting growth story and you would get capital to go with that. Today, you have to substantiate so much more in order to get the same amount of capital and probably also to a lower valuation. I think the key question then is that if you are along the way, say that you have raised Series A or so, you need to know when you can basically turn over to more optimizing for profitability rather than for further growth. And if the markets further deteriorate, that becomes an even more important decision. But if they improve, then perhaps you can step on the accelerator again and grow further. Having that strategic degree of freedom is really key, and that's what most great entrepreneurs, have in them from the beginning.
Like you, Fred, jump in.
Yeah, I was going to say, if we look at the collective responsibility of the ecosystem in creating crises, so it's both founders and VCs, it's that when we price companies, say we've seen $3 million Series A companies priced at 200 to 400 million, right? We've seen a bunch of these deals come through. We're then putting these startups on these insane hyperspeed treadmills where they have to grow into that valuation. Now we're skewing behavior because of the price that we collectively agreed to put on the companies. And I think we go back to this, what is a reasonable rate of growth, both in your company and your valuation, that a company can achieve without vaporizing cash? And I think that's what I'd love for us to get back to, which is this, we're building based on first principles, not with the valuation tail wagging the operational dog.
Sarah, now with your brand new fund, Conviction Capital, what excites you the most? Which startups, which ventures do you want to invest in? Maybe there is something for the audience here as well.
Yeah, I've been lucky in my career as an investor thus far to be part of companies solving problems in a really wide range of domains, largely in B2B. But as we were discussing backstage, a lot of these companies are taking much more innovative and sometimes consumer-like initial growth paths, right? And one thing that I've personally spent a lot of time on is understanding the modern enterprise that looks like a Figma or a Datadog. These are companies where you're driving toward community or user-led adoption. And to the point of this panel, you're not profitable for a long time. You might not be generating revenue for a long time because you're focused on adoption first.
And a lot of iconic businesses, also YouTube and others, they first of all were like really scaling, and then became profitable, isn't it?
Right, and some of these are just, it's kind of the opposite of the lean startup in that the MVP of the business that's feasible for Figma or YouTube is quite a large product, right? They're just ambitious businesses. And so I think one of the fun things that I'm building expertise in is how to predict that and then how to take very long-term oriented bets. And then broadly, some of the domains that I'm interested in the application of machine learning include just operational enterprise efficiency, different types of vertical software. I recently did a legal SaaS company that is doing document understanding and document generation with large language models. But the problem domains that AI applies to today are massive.
You mentioned predictability, which used to be something that we all relied on in macroeconomics and finance and business and so on. It's a very philosophical question. So, PJ, are things still predictable?
Well, I don't think we rely on predictability in the venture space. It's that chaos that Fred mentioned that is sort of the lifeblood of what entrepreneurs go at, and they create businesses out of that dynamics and find change vectors to really capitalize on. So I would say that stability is probably the enemy, or lack of stability is probably the enemy of the incumbent space, which basically are the enemies of ours as well.
Yeah.
If we're really
I completely agree, yeah. And I think there are a lot more. I'm one of these like new fans, but I think there are a lot more fans of F1 than there used to be. But the story of F1, in terms of like being able to advance as a team, is if it's raining and the conditions are terrible, anyone can win, right? If it's a sunny, clean track, Mercedes wins, right? Because they built the fastest engine. They can do the same thing every time. And so I'm an optimist by nature, but I think to your point, in a environment of chaos when it's raining out, and more positively, when you have such step change functions in the underlying technology like machine learning, the companies that are more agile and can take more risk are more likely to win.
I love it that the Americans have discovered F1 after 30 years. Yeah.
But we have Formula E, isn't
Yeah.
it? I was just at my first Formula E race in Monaco this summer, which was even more exciting because you can't hear them and then just speed next to you. You obviously, PJ, were an early investor in some of these incredible startups and unicorns like Spotify, also Avito or Price Runner. But obviously you also listen to your gut feeling, isn't it?
Oh yeah, absolutely. It's and I think you can just find so much in the pitch deck or in the conversations about CAC to LTV ratios and all that stuff. What really boils down is to what if there is this like A+ quality to the founder team that has this capability to really move mountains, to convince other really top quality people to join their path, even if they're much smaller than they would normally be.
Mm-hmm. Would you agree with that, Fred?
I mean, I think if I look back at my own decision making, it's like within 3 minutes or 5, I'll know if I want to fund you. Within 15, I'll probably know if I want to fund your business. And then if the next morning I'm still obsessing about it and it's not out of my brain, then I'm in. And then I'll rationalize my way back because I learned over time to be disciplined. Ooh. But it is an act of faith, at a deep level, because you're a conviction investor, I'm a conviction investor, so are you. And conviction, at the end of the day, comes from our gut. Now, we'll inform our gut feeling, but it is very much jumping over the edge with a management team. And I think people sometimes forget. They think we're machines, but we are fucking loving machines and caring machines and mission-driven machines.
I love that.
That's why Sarah's new fund is called Conviction Capital. So if you have to boil it down to one decisive factor, what would you name it? Is it like a human connection? Is it the financial situation? What makes you decide for that specific startup in the end?
For me?
Yes.
It is a unique insight or view on the world delivered by people that raise my energy.
Very good. We don't have much time left, just about 60 Swiss seconds or 59. So in the last moment that we have, Fred, tell me, looking into the crystal ball, which will be the #1 topic dominating the VC industry in 2023?
That is a tough question. I'm going to pass it on to Sarah.
Sarah? The war in Ukraine, recession.
I feel like
funding.
many mature funds are going to be managing a portfolio full of pain next year.
Portfolio full of pain.
I would agree to that, but there is like a massive bifurcation with the winners and the losers, where winners will continue to attract a lot of capital at high valuations and grow like crazy because there's this underlying undercurrent of change that is happening and that's continuing to happen despite these challenging sort of equity markets.
And I think it's going to be beautiful for emerging managers because dislocation in the industry creates daylight. And I think we're going to see the likes of Sarah and a bunch of emerging managers come in with great product for founders. So I'm actually excited about, breaking the status quo and continuing to unravel and break up and reinvent the venture industry.
We'll end it with this optimistic note. Fred Destin from Stride.VC, Sarah Guo from Conviction, and PJ Pärson from Northzone. Thank you so much.
Thank you.
Thank you.